Everyone thinks smart investors can predict the exact bottom of the market. They can't. And the ones who try usually lose money, but the ones who build real wealth, they do something completely different. There's a silent myth in the market that if you're smart enough, experienced enough, or disciplined enough, you can call the bottom. But the truth is, market bottoms don't announce themselves. They feel uncomfortable, uncertain, and honestly, a little scary. If it feels obvious, it's probably not the bottom yet. So the real question is not, where is the bottom? It's, how do you position yourself when it's forming? First shift you need to understand, a bottom is not a price, it's a process. It takes time, weeks, sometimes months. And during this phase, something interesting starts to happen. Panic begins to slow down, sharp falls start getting bought faster, and bad news stops pushing the market lower. That's your first clue, not to go all in, but to start paying attention. Second, sentiment. At market bottoms, confidence disappears. People stop talking about opportunity and start talking about survival. You'll hear things like, "This time is different. Markets won't recover. Stay in cash." And this is where it gets interesting. Because when expectations are completely crushed, risk actually starts reducing, not because the market is safe, but because everyone already expects the worst. Third, price action. Forget predictions. Price is truth. When a market is bottoming, you'll notice breakdowns start failing, prices drop, but quickly recover, and slowly, quietly, higher lows begin to form. Also, strong stocks stop falling. This is where experienced investors step in, not aggressively, but deliberately. They don't wait for certainty, they wait for improvement. Now, this is important. Trying to catch the exact bottom is ego. Making money is strategy. Smart investors don't go all in. They scale in, they start small. Add more when the market confirms strength, and increase exposure as the trend improves. This does two things. It protects you if you're early, and rewards you if you're right. Because being early and being wrong feels exactly the same in the beginning. Here's something most people miss. At every market bottom, leadership changes. The stocks that were falling the most are usually not the ones that lead the next rally. Instead, watch for stocks holding near highs, quick recoveries after dips, and rising volume when prices go up. That's where real opportunity is, not in the weakest names, but in the strongest ones. And now the hardest part, psychology. Buying near the bottom doesn't feel good, it feels uncomfortable. You'll doubt yourself. The market might fall again after you buy. That's normal. That discomfort is the price of admission, because by the time everything feels safe, the opportunity is already gone. So remember this, you don't need to predict the bottom to profit from it. You just need to recognize when conditions are changing. Less fear, less selling, more resilience, and then you act slowly, deliberately, without trying to be perfect. Because wealth in markets is not built by calling turning points, it's built by positioning yourself around them. If you think differently about markets after this, subscribe, because this is how real wealth is built.